Ever find yourself thinking, have I saved enough for a rainy day, or did I make the right financial moves over the years? Hitting your 40s and 50s can feel like a turning point, where the carefree spending days are behind you and thoughts of the future start to creep in. But here's the good news. It's never too late to start. Whether you're just beginning to take your investment seriously or you've been at it for a while, this video was made to make investing simple and easy for you without needing to read any investment books. All I ask is that you don't skip through this video. We'll dive into practical steps and offer a full tutorial to help you invest in the stock market, dividends, and cryptocurrency like a pro, even if you're a complete beginner. Let's dive in. Your 40s and 50s are crucial decades. These years bring a mix of excitement and concern as you realize that while retirement is closer than it used to be, there's still time to make impactful decisions. This period is about balancing growth with security, taking advantage of the time you have left and ensuring that your wealth can sustain the lifestyle you want to live. The first thing you should have on your list before diving into stock or cryptocurrency investments is to take a step back and assess your financial goals. Your 40s and 50s are a time when your priorities may shift, and so should your investment strategy. This phase of life often brings with it a clearer picture of what you want your life to look like when you are no longer working. The sad truth is that you won't be working forever. Or are you planning to become an employee all the days of your life? Well, you are not destined to keep working for people all the days of your life. The first step in understanding your financial goals is to evaluate where you currently stand. This means taking stock of your assets, liabilities, income, and expenses. Are you on track to meet your dream life? Do you have any debts that need to be paid off? Are there any big expenses on the horizon like college tuition for your children or a new home purchase? By understanding your current financial situation, you can make more informed decisions about how to allocate your investments. For instance, if you're behind on your retirement savings, you may need to prioritize aggressive saving strategies or consider working longer to make up the gap. On the other hand, if you're in a strong financial position, you might have more flexibility to take on higher risk, higher reward investments. But don't jump on this yet. Just continue watching and I will break down as we progress. Setting realistic retirement goals in your 40s and 50s. Let me tell you, it's crucial to set realistic investment goals. This isn't just about picking a random retirement age or savings target, it's about envisioning the kind of life you want to live when you are no longer working or able to work. Do you plan to travel extensively? Will you downsize your home or perhaps move to a different city or country? What hobbies or activities do you want to pursue? These questions are vital because they directly influence how much money you'll need in your retirement planning. Once you have a clear vision of your dream lifestyle, you can work backward to determine how much you need to save and invest. Tools like retirement calculators can help you estimate these figures, but remember that these are just starting points. Your personal goals and circumstances will require adjustments. Importance of a diversified portfolio. As you define your financial goals, it's also important to consider how your investment portfolio should evolve. In your 40s and 50s, the focus should start shifting from growth to preservation. While you still want your investments to grow, protecting what you've already accumulated becomes increasingly important. A diversified portfolio can help you achieve this balance. Diversification means spreading your investments across various asset classes, such as stocks, bonds, real estate, and cash. This reduces your risk, as the performance of one asset class may offset the poor performance of another. For example, if the stock market takes a downturn, your bonds might hold steady, cushioning the blow to your overall portfolio. The key here is to align your portfolio with your risk tolerance and financial goals. If you're aiming for a retirement filled with travel and leisure, you might still want some growth-oriented investments in your portfolio. But if your goal is a simpler or more frugal lifestyle, you might focus more on conservative, income-generating investments. Adjusting your risk tolerance. As you move through your 40s and 50s, your risk tolerance should adjust. Kind of like how your tolerance for loud music and staying up past midnight changes as you age. What used to be exciting and adventurous like skydiving or investing in high-risk tech stocks now seems more like a recipe for a heart attack. Instead, you're probably more interested in stability and not waking up at 3 a.m. wondering if your investments have turned into financial quicksand. Balancing risk and reward. When you were younger, taking big risks might have seemed like a great idea. After all, you had time on your side to recover from any financial mishaps. But now, those wild roller coaster investments might feel more like the drop of doom at an amusement park. Sure, the rush was fun in your 20s and 30s, but now you're eyeing the kiddie rides with a bit more respect. And listen, there's no shame in that. Balancing risk and reward at this stage is all about protecting what you've built while still allowing for some growth. It's like having your cake and eating it too, except in this case, the cake is your retirement savings, and you'd rather not see it disappear into thin air. So, while you're not jumping on the next get-rich-quick scheme, you're also not burying your money in the jar in the backyard. It's all about finding that sweet spot between risk and safety. Shifting from aggressive to conservative investments. Now's the time to consider gradually shifting some of your investment from aggressive growth stocks to more conservative options like bonds. Think of it like trading in your high-speed sports car for a reliable sedan. Sure, the sedan doesn't have the same thrill factor, but it's dependable, gets you where you need to go, and won't give you a mini heart attack every time you hit a bump in the road. This doesn't mean you have to dump all your growth investments immediately. After all, you still want your portfolio to grow, but it's about dialing back the risk a bit. Instead of the all-you-can-eat buffet of risk, maybe it's time for a more balanced a la carte menu. Role of bonds and fixed income. Bonds and fixed income investments might not have been the same pizzas as the latest hot tech stock, but they're like that comfy pair of shoes you've had for years. Reliable, steady, and they won't give you blisters. Bonds provide regular interest payments, which can be a nice, predictable income stream, especially when you're inching closer to retirement. Incorporating more fixed income into your portfolio doesn't mean you're giving up on growth. It just means you're being smart about how you're securing your future. After all, slow and steady wins the race, right? And if that race leads to a peaceful, stress-free retirement, it's one worth winning. Diversifying investments. Diversification. The fancy word for not putting all your eggs in one basket. And let's be honest, at this stage in life, who really wants to deal with a basket full of broken eggs? The idea here is simple. Spread out your investments so that if one thing goes haywire, you're not left scrambling. Diversifying your portfolio is like having a balanced diet for your finances. Sure, you could live on nothing but pizza, and we've all been tempted, but mixing in some vegetables and maybe a smoothie here and there is a smarter long-term strategy. The same goes for your investments. You want a mix of different assets that can weather the ups and downs of the market. Importance of diversification in your 40s and 50s. In your 20s and 30s, you might have been able to get away with putting a big chunk of your money into high-growth stocks or the latest hot sector. But now in your 40s and 50s, it's time to start thinking like a seasoned chef. One who knows the value of having a well-rounded menu. You want a bit of everything on your financial plate. Stocks, bonds, Bitcoin, cryptocurrency, real estate, maybe even some alternative investments like REITs or commodities. It's all about spreading the love and the risk. Think of it this way. If one investment tanks, because let's face it, sometimes they do, you don't want it to ruin your whole retirement planning. By diversifying, you're making sure that even if one part of your portfolio has a bad day, the rest of it can keep the party going. And who doesn't want to keep the party going? Strategies for diversification. Stocks, bonds, real estate, Bitcoin, and more. So what does diversification actually look like in your 40s and 50s? Well, it's like mixing up your wardrobe. You wouldn't only wear suits, right? You've got casual clothes, workout gear, and that one pair of shoes you swear by. We all have them. Similarly, your investment wardrobe should have a bit of everything. Stocks. These are like your stylish outfits, the ones that can make a statement but might go out of fashion. You still want them in your portfolio, but maybe not as much as you had before. Bonds. Bonds are like your trusty everyday wear, dependable and a little less exciting but essential. They provide stability and regular income, which can help balance out the wilder parts of your portfolio. Cryptocurrency, Bitcoin. Cryptocurrency is like that wild roller coaster ride at the amusement park. Exciting, a bit unpredictable, and not for the faint of heart. It can offer huge gains but comes with significant volatility. While it can be a thrilling addition to your investment mix, make sure it's balanced with more stable assets to keep your overall portfolio from spinning out of control. Real estate. Whether it's your home, a rental property, or REITs, real estate is like that piece of investment property that adds some serious flair to your portfolio. It can provide steady income and appreciation, plus it's tangible. You can see it, touch it, and say, hey, I own that. Alternative investments. These are like the cool accessories that add a little something extra to your look. They might be more niche like commodities of private equity, but they can add some spice to your portfolio, especially if they perform well when traditional markets don't. Income-generating investments. When you're nearing an advanced age, generating income becomes a key focus. Kind of like how making sure you have enough snacks before a long road trip is crucial. You want to make sure your investments are working as hard as they can to bring in some steady cash flow, so you're not left in the lurch when it's time to kick back and relax. Dividend-paying stocks. Dividend-paying stocks are like those reliable friends who always show up with a pizza when you need it. They provide regular payouts, which can be a great source of income, especially when you're retired and not earning a paycheck anymore. Think of dividends as your financial version of thanks for coming after a great party. Money coming in just for holding on to certain stocks. Investing in companies with a solid history of paying dividends can offer a steady income stream and potential for growth. Plus, you get the added bonus of enjoying those quarterly dividends like financial mini-celebrations. Just make sure you're picking companies with a good track record, because nobody wants to invite that flaky friend who never shows up. Real estate investment trusts, or REITs. If direct real estate investment sounds too much like a full-time job, REITs are like the hands-off version of owning property. They allow you to invest in real estate without having to deal with tenants or toilets. It's the real estate equivalent of having someone else do the heavy lifting while you just collect the paycheck. REITs are companies that own, operate, or finance income-producing real estate. They're required by law to distribute at least 90% of their taxable income to shareholders, which means they can be a good source of regular income. Plus, they offer the added benefit of diversification, giving you exposure to various types of real estate, from office buildings to shopping centers. Annuities and their role in financial planning. Annuities might sound like something only your grandparents get excited about, but they can play a crucial role in your financial planning. Think of them as the financial equivalent of a dependable old car. Maybe not the most exciting ride, but it gets you where you need to go without any unexpected breakdowns. An annuity is a contract with an insurance company where you make a lump sum payment or series of payments in exchange for regular disbursements starting immediately or at some point in the future. They can provide a guaranteed income stream for a specified period or for the rest of your life, which can be comforting when you're planning for retirement. The key is to choose the right type of annuity for your needs, whether it's a fixed annuity for predictable payments or a variable annuity for the potential of higher returns. Just like with any investment, make sure to do your homework and understand the terms before diving in. Managing debt. When it comes to managing debt in your 40s and 50s, it's a bit like tackling a cluttered attic. You know there are treasures hidden in there, but first you've got to clear out the old junk and figure out what to keep and what to toss. The goal is to streamline your finances so that you're not weighed down by debt as you approach retirement. After all, no one wants to spend their golden years playing catch-up with bills instead of enjoying their time. Prioritizing high-interest debt like credit card balances or payday loans is like that annoying alarm clock that keeps going off. It's persistent and disruptive, eating away at your financial health with each passing day. Prioritizing and paying down high-interest debt should be your top priority, kind of like putting out a fire before it spreads. Start by making a list of all your debts, focusing on the ones with the highest interest rates. Then channel your efforts into paying these off first, while making minimum payments on lower-interest debts. It's like attacking the biggest mess in your attic first. Once the high-interest debt is under control, you'll find the rest of your financial situation becomes a lot more manageable. Strategies for reducing debt. There are a few strategies to consider when it comes to reducing debt. Number 1. Debt snowball method. Focus on paying off your smallest debt first while making minimum payments on others. As you knock out each debt, you build momentum like rolling a snowball down a hill until it becomes unstoppable. The psychological boost from paying off smaller debts can be motivating and can help you tackle larger ones. Number 2. Debt avalanche method. Focus on paying off debts with the highest interest rates first, which can save you the most money over time. It's like choosing to tackle the biggest and most troublesome items in your attic first, knowing that it will ultimately make the whole process more efficient. Number 3. Debt consolidation. This involves combining multiple debts into a single loan with a lower interest rate. It's like cleaning up your attic by getting rid of clutter and consolidating everything into one organized space. Just be cautious of consolidation loans that come with high fees or longer terms. Avoiding new debt. As you work on paying down existing debt, it's crucial to avoid accumulating new debt. It's like trying to clean your attic while someone keeps bringing in more junk. Set a budget, track your expenses, and stick to your financial plan. Make conscious spending choices and avoid impulsive purchases that can derail your progress. Consider using a credit card only for purchases you can pay off in full each month, and avoid using credit as a substitute for savings. Building an emergency fund can help you avoid taking on new debt in case unexpected expenses arise. Think of your emergency fund as a financial buffer that keeps you from reaching for the credit card when life throws curveballs. The importance of regular financial checkups. Regular financial checkups are like visiting your doctor for a routine physical. They help ensure that everything is running smoothly and that you're still on track to meet your goals. These checkups can reveal if your investments need tweaking, if you're overexposed to certain risks, or if you're not taking advantage of tax benefits. Schedule a review of your financial plan at least once a year. This is a good time to assess how well your investments have performed, whether your risk tolerance has changed, and if your goals have shifted. It's also a great opportunity to update your financial plan based on any major life events, like a new job, a move, or a change in family circumstances. Adapting to life changes. Life has a funny way of throwing curveballs at us, and these changes can impact your financial plan. Whether it's a new job, a significant raise, or an unexpected expense, it's crucial to adapt your plan accordingly. Think of it like recalibrating your GPS when you take an unexpected detour. You need to make sure you're still heading in the right direction. If you've had a major life event, take some time to reassess your financial goals and make any necessary adjustments to your investment strategy. This might mean reallocating assets, increasing savings, or revisiting your retirement timeline. Flexibility is key. The more adaptable your plan, the better you'll handle whatever comes your way. Adjusting your investment strategy. Over time, your investment strategy may need to evolve to match your changing needs and goals. As you approach retirement, you might want to shift from a growth-oriented approach to a more conservative one, focusing on preserving your wealth rather than seeking high returns. Revisit your asset allocation periodically to ensure it still aligns with your risk tolerance and retirement goals. For example, if you're closer to retirement, you might want to reduce your exposure to volatile assets and increase your holdings in safer investments like bonds or cash equivalents. It's like adjusting the balance on your stereo. Sometimes you need to fine-tune things to get the right sound. The role of professional advice. If managing your investments feels overwhelming, consider seeking professional advice. Financial advisors can offer expertise, help you navigate complex financial decisions, and provide a second opinion on your investment strategy. It's like having a co-pilot on a long journey, someone to help navigate and offer guidance when needed. When choosing a financial advisor, look for someone with a good track record, transparent fees, and the fiduciary responsibility to act in your best interest. A good advisor can help you stay on track and make adjustments to your plan as needed. And there you have it, a roadmap for investing in your 40s and 50s. But the real question is, what will your next move be? Will you start investing right away? Whatever your choice, remember, your financial future is in your hands. So what step are you going to take today to build the future you've been dreaming of? Let us know in the comment section below. And go watch this video above where I explained in detail how to move from making $100,000 per year to generating $1 million per year using the power of compounding. See you in the next video.